recording, and then I share my screen. And here we are. So we were discussing, that was the last point last time, the distinction between debt and equity. So a distinction that is, of course, relevant on the right-hand side of the balance sheet, because we literally have the distinction or the groups of equity and different types of liabilities and debt. It's also relevant on the asset side, because if you remember, the accounting for financial asset depends on if the asset is a debt instrument or an equity instrument. So we have the same distinction on both sides of the balance sheets, and then we can have financial instruments that are either debt and equity, and we can have financial instruments that are both equity and debt at the same time. And if that is given, we need to use split accounting, which means that from the very beginning, we need to separate the debt amount and account it for as a liability, and then the follow-up accounting for liability, and recognize the equity portion. Okay, so before we go further with accounting for equity, I ask you to have a look at the exercise number 7, where we actually have real financial instruments that have been issued in the past by Air France KLM. And for the 3 instruments, again, we have to decide or check out if it is debt, if it is equity, or maybe both at the same time. So the excerpts that you have here are the excerpts from the so-called issuance prospectus. So when a company issues financial instruments, well, in the European Union and elsewhere in the world, the company has to issue a prospectus, which means a document that describes all the features of the financial instrument. So here the prospectuses we are talking about are several tens of pages, so roughly 80 to 100 pages of documentation. So you see it goes very much in detail, and in particular contains all the legal dispositions. So what happens if the company goes bankrupt, etc., etc. So what you see here, exercise, actually, what I posted here in the Word document is just an excerpt of the executive summary of this document. Okay, and here we have the first instrument. It's a convertible bond that can be exchanged into new or existing shares of Air France. Okay, and we have the description of the bond. And for example, the bonds, that's something we can see here. The bonds will mature on February 23, if by then nobody has exercised their options. Actually, these bonds were issued, I think, in 2013 or 15, so quite a while ago. Okay, so after you have read the text here, what do you think? Do we have debt or equity, or maybe both here for this instrument number 1, a convertible bond? Any ideas, please? Convertible bond. No ideas. Well, convertible bonds is easy, so to speak, because we are always in the presence of debt and equity. Okay, so that means here we need to apply split accounting. If I go to my solution here for instrument 1, so here we have the main features. It's convertible. The holders can exercise their right to convert at any time. Initial conversion rate is given. The bonds will mature and may be redeemed, etc., and some other features. Okay, so here we have a compound financial instrument. That means we have to recognize a debt and an equity component from the very beginning. And as I said before, the bond was issued in 2013. And giving the numbers, well, they showed originally out of a bond volume of 550 million in total, 70 million was the equity component. So 70 million in share premium on the remaining 480 million as a debt. Okay. So split accounting here for this first financial instrument. Questions? Please, any reaction? Can you still hear me? Do you have questions for instrument 1? Okay, probably not. Then we move on for instrument number 2 that we have here. So it's a 750 million note with 1.875% coupon. And the notes are due in 2025. Okay. So any ideas what instrument number 2 may be? No ideas. Okay, well, same thing. If we look at the main features here of the second text, well, there's nothing fancy. There's a maturity, so reimbursement date. There's annual interest, etc. And also the issuer may redeem at its option the notes earlier. Okay, but anyway, remember, a liability or debt means I have an obligation to reimburse and I have an obligation to pay interest or an ongoing compensation. And here we have both given. So it means instrument number 2 is not a big deal. Instrument number 2 is a debt instrument. Okay, regular debt instrument, and therefore just fully a liability. Okay, and instrument number 3 for 400 million undated, deeply subordinated fixed rate resettable notes. Okay, what do we have here? Well, it's subordinated. Does anyone know what that means? Subordinated? Yeah, it's a subordinated fixed rate note. What does subordinated mean? Rank in a lower priority. Yes, that's correct. And that means here you are subordinated to all debt, basically. So all the debt holders will be reimbursed first, then the subordinated debt holders, and then the shareholders, basically. And here it's deeply subordinated. So that means it's even subordinated to potential other subordinated debt. You know that we can rank the different debt holders in senior debt and so on, mezzanine debt, junior debt, and so on, so different levels. And here it's deeply subordinated, so it means it's even subordinated to other subordinated debt that we may have. Okay, well, there is an interest payment that is mandatory, okay, but the payment of interest may be deferred at the option of the issuer, which means, okay, It's mandatory, but not really, because it can be deferred. And the notes are undated with no specific maturity date. That means there's no obligation to reimburse. Okay, so no obligation to reimburse, a limited obligation to pay interest. That means here we have issued a subordinated bond, but the bond will be classified as equity. Okay, so the whole financial instrument is equity. All right, and basically, if we have a look at the balance sheet of Air France, and this is our perpetual bond that we had here. In the balance sheet, we see this perpetual bond, and we see also that in 2020 it has been reimbursed, that bond. Okay, which means actually, so if we go back to the bond, we see that there are special dates where the issuer has the right to redeem the bonds. Okay, and one of those possibilities was in 2020. Okay, so they decided to reimburse in 2020. And actually, as soon as they make the announcement, because obviously you have to give advance notice that you will reimburse. So if I remember well, the reimbursement date was October 1st of 2020. So several months before that, you make an announcement that you will reimburse the perpetual bond. And obviously, this has accounting consequences, because as soon as you announce that you will reimburse the perpetual bond, you create an obligation, because now you engaged yourself to reimburse the bond, and obligation means liability. And that means as soon as I make the reimbursement announcement, actually the perpetual bond will be reclassified out of equity into financial debt. More precisely, short-term financial debt, so included here. And then, so they did this in 2020, okay, and then in 2020 you reimburse that debt because there will be a corresponding cash outflow. Okay, so here again the issuer with the option to reimburse, and as soon as you announce that, you have to reclassify the bond out of equity and into liabilities, because now you generated, by your decision, generated an obligation. Okay, that's it on exercise number 7 and compound and other types of financial instruments. Any questions on that? Apparently not so far. Let's see. Okay. Then we continue and have a more detailed look at accounting for equity. Okay, basically there is 2 ways how to increase equity. What are these 2 ways? There's 2 means, 2 fashions how to increase equity. What are these 2? And they're obviously here represented on the slide. So what are the 2 ways to increase equity? Issue new shares, indeed. That's one possibility. And that means we increase the contribution by shareholders, in a sense, because we sell new shares and the shareholders invest new money. And the second way how to increase equity is to make profits, basically, and obviously retain part of those profits. So here we have profits in retained earnings. We also have profits in OCI. Both are profits. So we could say that making profits and retaining part of those profits is the organic growth of equity. Whereas contributed capital or issuing new shares, well, it's a type of external growth, because I literally ask shareholders to invest new money in the company. Well, this difference is a little bit artificial, because obviously retaining profits is the same thing as paying out everything in dividends and then issue new shares. It's the same mechanism. No? But obviously retained earnings, or putting profits in retained earnings, make this more efficient, because we don't need a whole procedure of issuing new shares, etc. Okay, as I said, retaining, and I will explain this a little bit more in detail later. As I said, retaining profits is a type of organic growth of equity, and in a growing company, we should increase equity over time, by following the growth of the company, because a growing company may mean that we increase our asset basis, because I need additional equipment since I'm growing. I have additional sales revenue, therefore generating additional accounts receivable. I have higher inventory because I have a higher volume of activity. I have more cash, etc. So overall, in a growing company, we would expect that the balance sheet increases and assets increase, and all asset increases need to be financed. Well, if I finance all my asset increases with debt only, then obviously my debt level becomes dangerous, critical over time. And that means in a growing company, it's not so much recommended to finance all increases all the time with debt only. Therefore, I need some increase of equity over time, like following the growth of the company. And retaining profits is the way how to do this. So that's what we can observe empirically. When you see companies make profits, well, it is extremely rare, and I have rarely seen it actually, that the company pays out all profits as dividends. There will always be, some sort of retention and retention rules. So basically, that 40% of our profit is paid as dividends and 60% are retained. So a lot of companies actually publish and issue rules how to deal with retaining profits and paying dividends. Okay, so retaining profits is the organic growth of equity, and that's how we should follow the growth of our company. Issuing new shares and ask shareholders for new contribution, therefore, is not the normal way. Let's see how we increase equity. The organic growth is retaining profits. Asking shareholders for new share investments is something I would say that is reserved for, let's say, special occasions, specific events, where you need usually a big increase in equity, not just a small annual increase, but a big increase. So when would that be a case? What would be a special event? Well, of course, a special event would be issuing new shares to save the company, because, if we don't do this, the company may go bankrupt. So therefore, I will ask the shareholders to invest new money, additional money into the company. And if they agree, that means they try to save the company, but maybe they disagree, and that means they want to pull the plug and let the company die. Maybe another occasion would be a big takeover of another company. So you buy another company, it will cost a lot, very high amounts, very high risk. Any takeover is risky, of course. And maybe here also it would be unwise to finance the whole takeover with debt only. So I will finance probably the major part with debt, but then some residual part I will finance with equity, and I will issue new shares, for example. Or we issue new shares to bring in a new shareholder, for reasons or other. Okay, so increase equity by issuing new shares on special occasions, and otherwise organic growth, that means retained earnings. There are different types of shares. We discussed this already in exercise number 6. Ordinary shares would give you all the regular shareholder rights, voting rights, dividend rights, liquidation rights, information rights. Okay, and preference shares where you have an advantage in one of those rights, but you pay it, so to speak, with a disadvantage and some other rights. Okay, so talking more about shares and contributed capital. One thing we need to distinguish when we talk about shares is the nominal or par value, which is one thing, and the market value, which is something very different. And market value and par value have nothing in common. What I mean by this is, well, maybe my par value is 1 euro, okay, but the market value is maybe 10 euros, or maybe it is 150 euros. Okay, or maybe the market value may be 10 cents. Okay, so par value is one thing, market value is a different thing, and the market value and the par value are not at all related. For many companies, we don't, well, usually we don't even know what the par value is. I mean, I can find it, but for this, I need to check either in the statutes of the company or in the annual report. That's where I'll find it. But I need to search for it sometime. Whereas the market value of a company usually is pretty easy to find because you type this on the internet and in 3 seconds you have the latest market value of your shares if they are listed, of course. Otherwise, there is no market. Okay, does anyone know what the par value is? We all know what the market value is, but what is the par value or nominal value of shares? What is the par value or nominal value of shares? Well, yes, it's the face value, but what is the face value then? No. Well, is it the book value? Not really, but that's not, well, the nominal par value or face value, the terminology is not deducted from accounting. So the par value can be occasionally the book value, but not necessarily. So nominal par value, face value comes not out of accounting. It's not an accounting terminology. It's something else. Okay. No more ideas so far. Okay, yes, it's like the unit price of 1 unit of capital. That is correct, usually fixed by laws. Yes, also correct. And for a typical company, well, non-adjusted value, okay, but non-adjusted for what? For a specific company, where do I find the par value, the face value, the nominal value? I find it because we had one answer, it's fixed by law. Yes, I find it in the bylaws or in the statutes of the company. So when I create a stock corporation, because here we're talking about shares, so we need a stock corporation. When I create a stock corporation, I have to write, the founding shareholders have to write statutes, describing the purpose of the company, who are the shareholders, and so on. And they also have to write in the statutes what is the share capital, total amount, and how the share capital is composed. That means how many shares do we issue when I create the company, and what is the par value, nominal value, face value of one share. Okay. And well, it's fixed by company law on the rules on fixing the par value. In the European Union, it's very diverse and there are no clear rules. In France, for example, you can fix the par value very freely. So the par value could be €1, the par value could be 10 cents, €250, or €12.80. So there's a lot of freedom how to fix it. In Germany, for example, you also have a lot of freedom, but the minimum par value is €1. You cannot be below €1. Okay, but anyway, the par value is a statutory value. It's a legal value. Okay, and it's usually fixed when we create the company. It can be modified later on. Obviously, I can change that. If I want to do this, I need to change the statute. So I need a shareholder vote, which means it does not happen too often. I show you an example a little bit later, but it does not happen too often, changing the par value. And also, it has no economic consequences, because the economics of the stock is based on the market value, not on the par value. And since the par value and the market value are two different things, the market actually does not care what the par value is. That's not relevant. That's why usually we don't know what it is, and it's not important. As a shareholder, what do I want to do? I want to buy low and sell high. Well, buy low, sell high, that refers to the market value of the shares, not to the statutory value, not to the par value. And therefore, I don't care. So, in other words, statutory values, okay, I can find them. They're not really important, and they rarely change. Whereas market value, of course, well, I know it easily because it's on the internet. It changes all the time, every day, every minute, depending on how often the market price is fixed. And obviously, it's highly relevant for investment decisions. It's the only thing relevant, not the par value. So that could raise the question, if the par value is not relevant, why do I have it? Why do I need it? Well, it's mainly for legal reasons and some legal considerations, but frankly, I'm not sure if they are relevant. Well, they have been relevant maybe in times where markets were less developed, but frankly, today, the par value economically is not relevant at all. That's why some companies issue so-called no-par shares. So shares that officially do not have a par value. That means the only thing that you fix in the statutes is the number of shares. Okay, but even for no par shares, it's like an optical trick because we have a calculatory par value. Because we have total share capital, we have the number of shares. Well, if I divide total capital by the number of shares, I have like a calculatory par value. So even if the par value then is not fixed in the statutes, there would be a calculatory par value. But anyway, if you have no par shares, that makes it more difficult to confuse the par value of shares and the market value of shares, because sometimes people could be confused and taking one for the other and the opposite. But once again, par value is not really relevant, except for accounting purposes. Well, as we'll see, for those company law reasons that I mentioned earlier, legal reasons, well, we still need the par value and identify the par value for accounting purposes. Although, well, those accounting purposes, once again, are also not very relevant, economically speaking. Okay, but we'll see this a little bit later. So here we have the difference between outstanding shares, or the number of outstanding shares, the number of issued shares, and the number of authorized shares. And what does it say? Well, the number of outstanding shares can be smaller or equal, of course, to the number of issued shares, and the number of issued shares can be smaller or equal to the number of authorized shares. Okay, therefore now my question to you, what may be the difference between the number of outstanding shares and the number of issued shares? What could be the difference between outstanding shares and issued shares. Could also say issued shares, we could call them existing shares. Issued shares or existing shares. Any idea? Any idea? Exactly. That's true. Pong, there may be issued shares held by the issuer. In which case, outstanding shares are those not held by the issuer. That is true. So outstanding shares, therefore, are the shares that are on the market. They are outstanding, they are outside of the company, they are on the market. Okay, on the market in a larger sense. Does not necessarily mean I can buy them, because maybe 20% of the shares on the market are held by the family owners, and the family owners don't want to sell. Okay, but the shares hypothetically are on the market. They're outside of the company. And the number of issued shares are the existing. So the difference between those two happened or arises when the company buys back its own shares. And then we talk about so-called treasury shares. So in the case of treasury shares, the number of outstanding shares is lower than the number of issued shares. And we will discuss treasury shares a little bit later more in detail. Okay? So that's good. Difference between outstanding and issued shares. And now the number of issued shares or existing shares can be lower or equal to the number of so-called authorized shares. So do you have an idea what authorized shares can be? Authorized shares related to authorized capital. They are shares that the company already has approved to issue, like for employee stock options. Okay. Let's say yes. Okay, I would only change one word in your answer, Tong. I would replace company by shareholders. Okay, so here we are talking about shares that the shareholders have already approved to issue. We agree that anything that touches on shares, so issuing new shares, authorizing shares, issuing stock options, even issuing convertible bonds, etc., etc., all those transactions need shareholder approval. So the management makes a proposition what to do and justify why they think it's a good idea to do this and that. But the final decision is made by the shareholders. So here, authorized capital means the shareholders authorize the management to issue shares in the future, for example, for stock options, but also for other reasons, without asking the shareholders again, because they authorized it already. Okay, why would companies do this? Why would shareholders want to do this? And in particular, why would management want to do this? Why would they would like to have an authorized capital? Well, because it speeds up the issuing of new shares. Because let's assume we don't have authorized capital and we want to issue new shares today to save the company, to finance a takeover, to do whatever is necessary. the reasons for which I want to issue the shares, well, that means I would need shareholder approval, okay, to do that. If I need shareholder approval, I need to call in a shareholder meeting. And there are legal delays that I need to respect to call in the shareholder meeting. Okay. So it means I cannot, today we are Tuesday, I cannot call in a shareholder meeting for next Monday. That is not possible. Well, it depends on company law, but in most legislations, in most jurisdictions, that is not possible. Why not? Well, because before before the shareholders come to the meeting, I need to give them all necessary information, and the shareholders need time to read and understand and, get advice on this information. So therefore, we have legal delays, 6 weeks, 2 months, 3 months, etc. That means, okay, I need to call in a shareholder meeting, then I have to wait 6 weeks or several months before I get the authorization or not to issue the new shares. And once I get the authorization, then I can actually issue them, which takes some other time to make the proposition. Because the same thing, before you can propose new shares to shareholders, you need to publish a prospectus, for example. You need shareholders to give time to read it. And then usually there's a time frame during which new shareholders can subscribe to new shares. So all this is not done in one day. So in other words, all this takes time. And if I want to speed up the procedure, one step or one way to do this is to ask shareholder for general approval. Okay, and I issue or I ask them to authorize capital. So here we have an example in the next slide for the German airline company Lufthansa. And we see that on the shareholder meeting in 2019, the shareholders authorized the executive board until 2024. So the authorization is valid for 5 years to issue capital up to 450 million euros. Okay, and they can do this on one or more occasions for the payment in cash or in kind. So another payment, not in cash or in kind. So this is called authorized capital A. And in the same shareholder meeting, the executive board was also authorized until 2024 to issue an additional issued capital of 30 million, the so-called authorized capital B. So when we have smaller amounts like this, usually this is authorized capital for stock options. Whereas bigger amounts usually are for other occasions, saving the company, convertible bonds. I have to issue new shares because investors decided to convert their bonds and so on. Okay, so the authorized capital A here for Lufthansa has not been used yet, but the authorized capital B was used at the end of 2020. Lufthansa has already issued 7.6 million euros of new equity based on this. That means for the capital B, there's still a remaining amount of 22.3 million euros. Okay, so that's authorized capital. That means the authorized shares basically is the number of issued shares plus new shares that do not exist yet. They will be issued, maybe they can be issued, but it's not mandatory if the company or management uses the authorization that we have here. Okay, any questions on that? Outstanding shares, issued shares, and authorized shares? Probably not. Then let's see how the accounting goes for issuing new shares. Okay, so here we have a company that issues 1,000 new shares with a par value of 5 euros, and they issue them at 15 euros per share. And then we check what the accounting impacts are on the balance sheet. But first of all, I have another question. So 15 euros is the issuance price of the new shares. My question is, where do I get the 15 from? Who determines that the issuing price of the new shares is 15 euros? And how do we determine that? The people who do that. Any ideas? Who fixes the selling price of the new shares? Any ideas, please? Well, is it the company? Yes. So it's the management of the company. That is true. With shareholder approval, obviously. So the shareholders need to approve. Question now, how do we fix the 15? Why do I sell them at 15 and not 16 or 13 or any other value? How do we get to the 15? How does the management, the CFO, well, together with the investment banks, obviously, who advise us on this question, how do we fix the 15? Why 15 and why not more or less? Okay, we make a company valuation. All right, that's correct. But for listed companies, for example, I don't need to do a valuation because I have already an indication. It depends on retained earnings. Unfortunately, no, this is not correct. Retained earnings relates to, we could say, the book value of equity, because we have retained earnings in the balance sheet. However, people on the market don't care about the book value of shares. They care only about the market value. Okay, so where do I get the 15 from? Okay, it is the market price. Maybe, so that's a good way to see this. So imagine the market price of our shares today when we make the decision. The market price of our shares is 13 euros. But since the management fixes the selling price of the new shares, and we internally, we know the company much better than the market. Therefore, we want to sell the new shares for 15 euros because we know intrinsically that the company is more worth than what we see on the market. So market price is 13 euros. We know better and therefore propose the new shares for 15 euros. Do you think that is a good idea? Well, cash expectation need from the company. This answer is correct and not correct, or let's say it's true, but it's not answering the question actually. Indeed, why does the company issue new shares? Because the company needs money. So here, for example, we could say, since I'm selling 1,000 shares for 15 euros, I need, or I want 15,000 in cash. That's why we're doing the whole thing. Okay, so I need 15,000 in cash, but obviously there's a multitude of combinations of doing this. The 15,000 in cash could be 1,000 shares for 15 euros, but I could also issue 10,000 shares for €1.50, or 500 shares for 30 euros, etc. So yes, the cash expectation, that's the final result. That's why I'm doing the whole thing. But that does not tell me how I fix the selling price. So once again, my question, if the current market price, market value of the shares is 13 euros, is it a good idea to propose the new shares for 15 euros? Now, everything you're telling me here is right, but you are not answering my question now. Current market price is 13 euros. Well, let's put it differently. I will do a poll. Then you will answer me. Tell me what the question is. Where is the poll? Yeah. Okay. Market price is 13. Is it a good idea to issue or to propose new shares for 15? That is my question. And you can answer. So what do we have? Where's my poll? Okay, well, the poll disappeared. Sorry, I did the wrong, put the wrong button. So let's do this again. Sorry for that. Market price 30. Issuance at 15. So yes, no, idea or not. Sorry, I have to repeat it. Okay, well, we have very equal results, mixed results. 6 people think it's a good idea, 6 people think it's a bad idea, and 1 person doesn't know. Well, question is, remember here we talk about shares that are listed on the stock market, okay? So the market price is 13, and then I try to sell new shares for 15. How many people do you think will buy the new shares? Okay, so existing shares cost 13 euros on the market. New shares cost 15 euros with the company. Both shares, the old ones and the new ones, give me exactly the same rights. Same dividend right, same voting rights, same everything. The shares are identical. There's no difference between the old ones and the new ones. So how many people do you think will buy the new shares for 15 euros? Okay, I'm surprised, Song, by your answer. Let's see what other people think. Well, Tung Tran, that's good. You choose no. I won't buy new shares. Well, probably very few people would buy new shares, or maybe nobody. Because if I can buy the same thing for 13 euros on the market or for 15 euros with the company, well, obviously I would prefer to pay less on the market. Yeah, but Raman, even if the company has very attractive news, the attractive news is already incorporated in the 13 euros. If there is attractive news, the share price goes up. So that's already incorporated. So that means if I propose an issuing price that is higher than the market price, that would endanger my objective. Remember, my objective is to raise money. In the end, I want cash of 15,000. That's my objective. So if I propose a selling price that is higher than 15 euros, well, not many people will buy the new shares. That means probably I will not reach the 15,000. Okay, so therefore, when the market price is 13, an issuing price of 15 is not a good idea. So how about the market price now is 15 euros, and now I decide to issue the new shares for 15 euros. So let's say that the market price is like the upper limit of my potential issuing price. So what do you think now? Market price is 15 and I want to issue new shares for 15. Is this a good idea? Yes or no? Any idea here? So same thing. Let's do a quick poll. Okay, so now market price is 15, issuance at 15. Is this a good idea? Okay. So some people think it's a good idea. More people think it's not a good idea. So why do you think it's a good idea or maybe not? Someone? So those who said it's a good idea, why do you think it's a good idea, please? The market price is 15. Anyone? A reaction of those who said it's a good idea or of those who said it's a bad idea? Majority said it's not a good idea. Why not? Well, because remember, my target is I want to make sure that I sell all my shares. I want to sell 1,000 shares at 15 so that I get my 15,000 in cash. That's why we're doing this. Okay. Well, if I propose the new shares for 15 euros, which equals the current market price, well, okay, now the investors are equal to either buy the shares on the market, the existing shares, or buy new shares with the company. But that means there is no specific incentive for shareholders to buy the new shares. And since there is no incentive, that makes it maybe difficult or dangerous to reach my target. Maybe I do, maybe I do not, but it's risky. Okay, therefore, usually I need to provide an incentive for people to buy the new shares. And how will I do this? Well, I will give an incentive by proposing the new shares with a discount compared to the actual market price. So that means if the market price today is 20 euros, then it makes sense to propose the new shares for 15 euros because there's a 5 euro discount. That's a 25% discount compared to the current market value. And that may attract enough people so that I can sell my 1,000 shares, cash in 15,000. Okay, so actually, when we issue new shares, usually we will sell them with a discount compared to the current market price. In France, historically, the discount is 20 to 30%. So here we have a discount of 25%, which is in the historic average. But in certain times or difficult times, special circumstances. So for example, in the financial crisis, 2009, 2010, and so on, for example, banks had to issue new shares in the middle of a banking crisis. So I have to attract new shareholders, even though we are not sure that some of the banks will survive. So here you can imagine that you need a very high discount to attract new shareholders. And indeed, shares issued at that time usually they had a discount of, for example, 90% compared to the market price. So market value 20, I proposed the new shares for 2 euros. That means they are so cheap that I attract enough people to take that risk. Yeah? So usually we issue them with a discount, and that means I will look at the market price evolution and forecasted market prices and so on. I will apply a discount on this, and that's how I get to the 15 euros. Yeah? Usually what companies also do before is a procedure that is called book building. Yeah? The book building procedure that I do when I issue new shares. And book building, actually, what does it mean? It means I will ask potential investors before issuing the shares. So I will go to institutional investors and I will tell them, okay, the current market price is 20 euros. I want to issue new shares. And if I propose them in a range of 15 to 18 euros, for example, how many shares would you be willing to buy? So I ask institutional investors, banks, insurance companies, etc., or some reference shareholders that I have, and I ask them, okay, if I propose new shares in this price range, 15 to 18, how many shares would you buy? And then they tell me, okay, for example, at 18 euros, I would buy no shares at all, but at 15 euros, I would buy 500 shares. Okay, so I have a wide range of responses. And that tells me if I set the price, the issuing price at 15, how probable it is I can sell all my shares. So that makes it safer to be sure that all the shares will be sold. Okay, question so far? That's not the case. Then it is 8 o'clock. I propose that we do the dinner break, which means I will see you again in 30 minutes. That means roughly at 8:30 for you. Okay, this is good for you. 30 minutes dinner break. Okay, see you. So we were talking about accounting for equity and issuing new shares. So we have seen that the issuing price is basically the market value that we have today minus discount. So we need to propose a discount to potential investors in order to make sure that we can sell the 1,000 shares, because as I said, my main objective is to cash in 15,000 money that I need for an investment project, for example. Obviously, there can be exceptions from setting the price with a discount. For example, if we issue shares to a particular investor, you know, like someone who will save the company, or the government takes on shares, etc., then we may have maybe issue the shares at the market price, for example, or at another negotiated value. No? Also nowadays, the success of issuing new shares is not measured by the fact that I succeed to sell my 1,000 shares, and that is more or less normal and expected, but it's more measured by how many times the share issuance is oversubscribed. So, for example, if a company wants or proposes to sell 1,000 shares and is just selling the 1,000 shares, which would be enough to raise the cash that I need, that would not be considered as a success, because you just were able to sell the proposed shares. It would be a success if you had a demand to buy 2,000, 3,000, 4,000 shares. That means the offer would be oversubscribed 2, 3, or 4 times. Because that would mean there's a big market demand, and that means the market overall thinks it's a very good idea to buy those shares in a good project. Okay, all of this very nice. Now let's go back to the accounting. So we issue 1,000 shares. They have a par value of 5 euros, and the selling price is 15 euros. So I will cash in 15,000, 1,000 times 15. And I need to increase my equity by 15,000 because new shareholders invest money. But within the equity section of the balance sheet, we have different line items. And there's one line item called share capital. So it can be called share capital, subscribed capital, issued capital, etc., different names. But usually it's the first line in the equity section. And in the first line of the equity section, actually, I will account for only the par value of the shares. And since I have 1,000 shares with a par value of 5 euros, well, that means my share capital line increases by 5,000. But since shareholders pay me 15, I need to account for the remaining 10,000. And the remaining 10,000 usually go in the second line item that I may have in the equity section with different names. Maybe it's called share premium. Maybe it's called APIC. So APIC, remember, on the first slide is additional paid in capital. So that's US terminology. So APIC, which is a share premium. So in the share premium or APIC, I see the difference between the selling price of the shares and the par value of the shares. So that's my share premium. So the share premium clearly is money that shareholders have invested, okay? And it's a premium. Well, why? Well, like you could explain it this way. The founding shareholders, they paid the par value at 5 euros. Since then, the company is doing good. And how do I know that the company is doing good? Well, because currently the share price is 15 euros. So it's higher, much higher than the par value. So it means here we have a successful company. Any new shareholder that buys shares of this company obviously immediately benefits from all the good things that have been created in the past. The brand name, customer basis, reputation, etc. And therefore, any newcomer shareholder needs to pay like an entrance fee to be part of this adventure. And here people pay 10,000 or 10 euros per share of share premium without getting any extra advantage for this. Remember, old shareholders paid 5 euros for one share. New shareholders buy 15 euros or pay 15 euros for one share. They both get the same rights. The voting rights, dividend rights, and so on are the same. So new shareholders are willing to pay a premium to get into this company as a shareholder because they are convinced of all things, positive things that have been done in the past. and that's why they pay this share premium. Okay, that's how we issue shares. Questions on that? Pretty much straightforward. So obviously, as I said before, usually we don't know the par value of companies, but most par values are set pretty low, €1, €5, €10, whereas market prices can be much higher. That means it's normal in many companies to have a share premium amount that is bigger than the share capital, because share capital is only the par value. The premium is based on market value and par value, obviously. And therefore it's normal to have a share premium that is higher. This slide here also shows us how the market value of my own shares influences my balance sheet. And how does the market value of my own shares influence my balance sheet? Well, the answer is not at all. Okay, I do not account in my own balance sheet for my own market value. What I see here is some influence of the issuing price, but remember the issuing price of 15 is not the market value. Market value is probably higher than that. And also that's only based on the market value of today. But obviously tomorrow the market value is 30 euros, 40 euros or 5 euros because it dropped. Well, how does this impact my balance sheet? Well, not at all. Okay, so my own market value has no influence whatsoever on my own balance sheet, which is logical, because the market price goes up and down every day, but compared to yesterday, in my balance sheet yesterday, what has changed today? Well, not much. I have the same equipment, I have the same liabilities, I have the same people. So accounting wise, there is no big change compared to yesterday, and that's why market values are forward looking. Most financial statement numbers are backward looking, at least for the good news. Okay, so my own market value has no influence on my own balance sheet. All right, questions to that so far? Apparently not. Okay. Cost of issuing stock. So we have underwriting costs, legal fees, investment banking, printing cost, maybe taxes, fees for introduction to the stock market. I have the fees for the prospectus that I need to propose. All these costs are not considered as expenses. They are deducted from the share premium directly. Okay, that's the general rule, is that transactions on my own equity do never impact my own income statement. And the same way, when I pay dividends on my equity, that is not an expense. It is money taken out immediately from my equity. So same thing here for the issuing cost. All the issuing cost is not an expense in the income statement. It is taken directly out of equity, taken out of the share premium. Okay, that's it. Then here we have an example that I mentioned earlier on reduction in share capital. So not increase, but decrease in share capital. But you see it's an older case. So it's already 10 years now. And in August of 2010, Air France reduced its capital, reduced it from 2.5 billion euros to 300 million euros. So remember, the issued capital or share capital equals the number of shares that the company has issued, multiplied, so the number of shares issued multiplied with the par value. Okay, so number of shares multiplied with the par value. That means if I want to, well, obviously, if I want to increase my share capital, I could also do this by increasing the par value. But when I do this, obviously, there's no cash inflow. Therefore, it doesn't really make sense. The same thing when I have a capital reduction, I can either reduce the number of shares, that means delete some shares, or I can reduce the par value. Okay, so here Air France decided to reduce the par value because before that date the par value was €1.50 and they reduced the par value down to €1. Okay, that means here in 2011 actually the 300 million means I have a par value of €1 and I have 300 million roughly outstanding shares. And before that, we had 300 million shares, but with a par value of 850, and that's why we had 2.5 billion of issued capital. Now, changing the par value of the shares has no economic consequences. Remember, the par value is just a legal value. Does it mean the company goes better or worse? No. Does it mean there's an influence on the stock price? No, because there's no good news, there's no bad news. The number of shares is not modified. It's just the par value. Remember, well, now shares, at least in France, are all electronic. Before that, the par value was the value printed on a share. But what does economically change if you modify this printed value? Well, nothing. Okay, so that means here, when I reduce my issued share capital, okay, I will not return any money to the shareholders, so I will not reimburse them. That means, well, they paid me at one point in time, they paid me 2.5 billion. Since I do not reimburse them for, the difference of 2.2 billion, the 2.2 billion are still in the company, are still in equity. And what do? Is I reclassify them into premium, share premium or additional paid-in capital. So I recalculate. Obviously, before the premium was only any excess over €1.50, but now the share premium is any excess over €1. So that includes €7.50 for each share that I had before. And that means here I see there's a decrease of 2.2 billion. And then there is an increase of 2.2 billion in the share premium because it's only reclassified. No? The total amount of equity, so capital and additional paid in, or share capital and additional paid in capital, the sum of this is exactly the same. Because shareholders do not invest new money, shareholders are not reimbursed, so the total amount stays the same. Okay, so that's a reduction in share capital. Now, do you have any idea why Air France would do such a reduction in share capital if economically it has no meaning? Nothing happens. No, I'm not reimbursing shareholders. Okay, the share price will not be impacted of that. So why then do I do this? No? Why do I do this? Well, it's related to corporate law and to some specificities we have in France and in Europe. So there is a rule in French corporate law. So it's not accounting, it's company law. There's a rule in French company law that the issuing price of new shares has to be higher or equal to the par value of shares. Okay, so in other words, if my par value is €8.50 and I want to issue new shares, I have to issue the new shares at least for €8.50. I can sell them at any price above this, but not below €8.50. And in 2011, actually, the share price of Air France was €9. That means we were very close at the par value. And now you understand, if the market price is 9 euros and usually I need to sell them with a discount of 20% or 25%, that would not be possible, given that my minimum selling price here is, because of the par value, 8.50 euro. And therefore, at that time, Air France was blocked and had no possibility, basically, to issue new shares. Therefore, they reduced the par value, okay, and now they have some, room of maneuvering, because even if the share price is 9 euros, my par value is 1 euros. Well, there's a wide range of potential issuing prices that I can propose. Right now, the Air France share price is around 5 or 6 euros. So it's even worse than it was in 2011. Well, because of COVID, of course. But still, even at 5 euros, if I propose new shares with a 20% discount, that would be 4 euros. Well, we're still way above the par value. So a very low par value means that this corporate law limit that I need to issue shares at a higher value than that is not really a restriction, because hopefully my share price stays well above 1 euro. Okay. That's an example for a reduction in share capital where I changed the par value. Later on, we'll see a reduction where I change the number of shares, which also is possible, but that's a little bit later. Okay, and we will talk about so-called treasury shares. So what are treasury shares? Well, treasury shares is when a company buys back its own shares on the market. So we said this earlier, the number of outstanding shares, the number of issued shares, and the difference is share buybacks. And they are called treasury shares. Why? I don't know, but that's the terminology. Okay, so why would companies buy back their own shares on the market? Why would you do that? Well, here's a list of reasons. And, well, the most important one is that buying back shares is an alternative of distributing cash to shareholders. Because what's the regular way, the normal or the traditional way to distribute cash to shareholders? Cash dividends, indeed. That's the traditional way. Now, dividends have a certain number of inconveniences that distributing cash via treasury shares does not have. So what are the inconveniences of dividend payments? Well, dividend payments are highly visible, first of all, because, well, depending on the country, but in continental Europe, for example, dividends usually are only paid once per year, in the spring, April, May, around that March, April, May, companies pay dividends. When they do so, they make huge headlines, and you can see it all over the press. Of course, in the US, for example, they pay quarterly dividends, but still, every time they pay dividends, there will be some press articles, because it's highly visible. It's only a few times, once or a little bit more during the year. Therefore, it's highly visible. There is something called the signaling theory. I don't know if you have heard of this. You heard of the signaling theory? It's a theory that is used in general to explain how companies work. But in particular, it's also used in finance. You know the signaling theory? Well, no. Overall, it means the company is a black box for outsiders. So you are an outside shareholder, you are customer, you are supplier, etc. Well, what happens in this other company that you are looking at? you don't know in detail. You know they produce cars, okay, so you know raw materials go in there, and at the end of the production process, they produce cars. But how all this is organized inside the company, you don't know. It's a black box. You know, even sometimes people working in the company, they don't know what's going on. It's also a black box, but outside, that's really the case. That means as an outside investor or outside creditor, it makes it hard for me to understand really what's going on inside the company. However, I know that the management of the company is an insider, obviously, and the management knows much better than I do how the company works. And therefore, what I will do is I will pay attention to what the management says, what the management does, in order to find out what the real situation of the company is. Is it better? You know, I don't know. I don't know exactly what's inside. But if, for example, the management gives, you know, a positive impression, that probably tells me that the company is doing good. And if the company gives me a negative impression, that means something maybe is wrong. Okay, and one important element of this signaling are dividends. And obviously, the management knows that the market is observing what they are doing. And therefore, the management knows that dividends have a signaling theory. So how is the signaling theory with the dividends, or more precisely, dividend policy connected? Well, if you propose your shareholders to pay a dividend of 5 euros, for example, well, that is implicit a promise that I will pay 5 euros in the future every year. Okay. Therefore, if one day the company decides to increase the dividends to 6 euros, well, the market will take this as a signal. Because the management would only propose an increase in dividends if the management thinks that in the future they will be able to deliver 6 euros every year. They will do this only if they think that the company is capable of doing this. That means the company does well. Okay, so in other words, dividend payments have a high signaling effect, because it's highly visible, it's observed by the market. It's observed by the market. Therefore, it's difficult and dangerous to change, because every change in dividends, you know, sends a signal to the market, and maybe it's the wrong signal. Maybe I decrease dividends, but only for 1 year because it's COVID. But I need then to explain this and all of that. Okay. Well, for treasury shares, we don't have this inconvenience of signaling. Why not? Well, first of all, treasury shares or buying back your treasury shares is not something you do once per year. You can do this at many times during the year as you want. 20 times every day if you want to. Okay, so it's not a clear signal on key dates. It's spread out over the whole year. Then it has much less publicity. Most people don't even know, when we talk about treasury shares, what we're talking about. Dividends, everybody more or less has an idea what dividends are. Treasury shares, nobody cares. That means there's much less visibility, and therefore treasury shares, buying them not, have much less or no signaling function, or very little signaling function compared to dividends. Obviously, buying back my own shares, so treasury shares, is not something that is completely hidden. When I do this, I need to inform the market. So I need to publish a press release and saying we bought back our shares, etc. But it's just a press release, among many others. So it has not the same power than dividend payments. And also, treasury shares do not engage you in anything. So this year I can buy back for 2 billion euros treasury shares. Next year I buy back nothing, and the year after I buy back just for 500,000 euros. So there's no clear expectation as it is for dividends when I buy back treasury shares. Okay, so therefore, some companies prefer to reduce the amount of dividends and instead distribute cash in the form of treasury shares. In particular, in industries where the economic situation can be very volatile, such as high tech. So I was a market leader yesterday, and the next year I'm almost gone because of a new competitor. That means profits are very volatile. That means it's very difficult to engage in a stable dividend policy. So therefore, instead, maybe I promise no dividends at all, and I distribute only if my situation allows it. I distribute cash only with buying back treasury shares. Okay. Any questions so far on treasury shares? Not the case. Okay. Buying back my own shares and then destroying them, deleting them, can increase earnings per share and return on equity, because if I delete the shares, well, earnings per share is profit divided by the number of shares. Well, if the number of shares decreases, obviously earnings per share increase, for example. I can buy back my own shares and then give them to employees for stock options or as a bonus payment. Bonus that is not a cash bonus, but a stock bonus, for example. Buying back my own shares can thwart a takeover attempt, because if I buy my own shares and I'm holding them, well, that means there are less shares available on the market. If there are less shares available on the market, maybe it makes it more difficult for anyone who wants to take me over to buy those shares. And also to make a market in the shares. What does that mean? That means it is in my interest that the market for my shares is rather liquid, meaning it is easy for shareholders to sell their shares or for potential shareholders to buy new shares. Therefore, what I will do is I will mandate an investment bank. It's not the company doing this itself. I will mandate an investment bank to be a market maker for my shares, and that means the investment bank on a constant basis is offering and demanding shares. So, if the demand on the market is not high enough, well, the investment bank will step in and buy shares. If the offer in the market is not high enough, the investment bank will step in and offer shares and sell shares. And that means the investment bank, on my behalf, will buy and sell treasury shares, my own shares on the market, in order to, assure certain liquidity for the market. Okay, that's it on treasury shares. Questions so far up to here? Well, we see how the accounting goes. So treasury shares is related to equity. Everything relating to equity needs a shareholder decision. So here we have for Lufthansa in the annual report the authorization by shareholders to buy back treasury shares. Okay, and that means in the shareholder meeting of May 2019, the executive board was authorized to do that. This authorization is limited to 10%. Okay, that's something that is part of the German corporate law, but actually it's a European rule. So you will find the same rule in the European Union. It is not allowed for a company legally to buy back more than 10% of its shares. So there's an upper limit of 10%. So here the shareholder meeting just, confirmed this 10% threshold. Although it's not really a limitation, because you could avoid it simply by buying back your own shares, then delete them, then buy another 10% and delete them, and then buy a third time 10%. So you could do this in steps. But so far, no company has done this. Actually, it's rather rare that you have high amounts or high percentages of own shares that are bought back. So, for example, in 2020, at various points, you see Deutsche Lufthansa bought back 1.2 million of its own shares, and that corresponds to 0.22% of all shares. Okay, well, that means basically nothing, and we are far away from the 10%. So it's not really a limitation. And since we bought back only 1.3 million of shares, we can imagine that those shares are in particular for stock options. Well, we would have to check. But basically, since we have this small amount of shares, usually it's related to stock options. Okay. Now let's see how the accounting works if I buy back my own shares. So here we have the equity section of a company. They have an outstanding share capital of 100,000, so 100,000 shares and a par value of 1. There's a share premium of 900 and retained earnings of 300,000. So total equity 1.3 million. And now the company buys back 10,000 of its own shares for $11, which is the current market price. Obviously, you buy them back on the market. And that means you need to pay the market price for that. Okay, when I issue new shares, basically we have seen that before here. When I issue new shares, there's a cash increase and my equity increases. Now, when I buy back my own shares, I have exactly the opposite movement. That means my cash position will decrease. Okay, my cash position will decrease and equity will decrease. Okay, so that's what I do here. So my cash position decreases, and in equity now I put a negative number of 110,000, 10,000 times 11 purchase price. So that means I reimbursed 110,000 of equity to the shareholders. So before that, the shareholders had provided 1.3 million to the company. Now, since I reimbursed them 110,000, well, on a net basis, they provided only 1,190,000. Okay, so treasury shares, when I hold them, and they do still exist, treasury shares are deducted from equity, which is perfectly logic, and are presented as a negative number. And the total equity now has been reduced, and that's the equity figure I would consider for calculating my ratios, return on equity, debt equity ratio, etc., etc. Okay. Once I bought back my treasury shares, there are two possibilities what I can do with them. Well, subsequently, I can resell them on the market. So, like in a market making function, I buy them back today and then a little bit later I resell them. So, for example, sometime later, I sell now 1,000 of my treasury shares and I sell them at 15 euros, which obviously is the market price at the moment I sell them. Okay. Now, very important, when I buy and sell my treasury shares, that does not generate any gain or loss in the income statement. Remember what I said before. Transactions on my own equity do not impact my income statement. So here we agree that I buy back shares for 11 and then I resell them for 15. So hypothetically, I make a profit of $4, so 4 euros per share, hypothetically. But this profit will not appear in my income statement. Okay, so when I resell my treasury shares, well, basically that works like issuing shares, the same thing. So on the one hand, I will cash in money, 15,000, 1,000 shares times 15. And on the other hand, my equity will increase overall But first of all, obviously, my treasury position will get smaller because now I'm holding less treasury shares. Remember here, the amount is based on the purchase price of those shares. The purchase price was 11. So this was 10,000 times 11. And now I sell 1,000 of those shares. That means I need to reduce my treasury share amount by 1,000 times 11 because everything is based on 11 here. So I will do this, and reducing a negative number means obviously there is a plus involved. So now instead of being a minus 110 negative, it's only 99,000 negative anymore. So in other words, I increase my cash position, I increase my treasury shares position plus 11. Any difference between the selling price and the book value of my treasury shares, which is 11, is considered as a share premium. So here the share premium is positive. It's 4,000. 1,000 shares times the difference between the selling price, 15 euros, and the book value, 11 euros. So you can see this as a premium that people pay me because I give them shares that I had with the value of 11. I make them pay 15. So even those shareholders pay me a premium of 4,000 times 1,000 shares. And that's what I have. Questions, please, on this part here. I buy back my treasury shares and then I sell them. Any question? Okay, that's not the case. Next possibility, I bought back the shares, but now I decide to cancel those shares, or some of them. Now we decide to cancel 1,000 shares. Okay, that means first of all, in the cash position here, nothing changes. Okay, because I'm not selling them, I'm not paying anything, so no cash change. But I cancel the shares. That means I have now less treasury shares. How many less? 1,000. And in the line item treasury shares, they are valued at 11. So that means the same thing. The number of, or the amount of treasury shares, the negative amount will get smaller. And I do this by putting plus 11,000 in treasury shares. On the other hand, now I need to reduce my share capital. Why? Well, because the share capital is based on 100,000 shares with a par value of €1. But now the number of outstanding shares or issued shares decreases by 1,000. That means here I need to reduce the share capital amount by 1,000. Remember, the par value is €1. Okay, so there are 1,000 times €1 shares less, and overall 99,000 shares are remaining. Okay, so I take that out. And remember, I treasury shares, I paid back money to the shareholders, and now we delete the corresponding shares. And I paid those shareholders more for the shares. I paid them $11. I paid them more for the shares than the par value, and that means I reimburse them a premium. You know, when shareholders give me money, they pay me more than the par value. I receive a premium. If I pay to shareholders more out than the par value in a share buyback, well, actually, I reimburse a premium. That means here I need to reduce the share premium by 10,000 because I have a premium of 10 euros, difference between 11 and 1 euros, and 1,000 shares. So therefore, my premium here will decrease by 1,000 shares. Okay. So that means before, in the Air France example, we had a capital reduction and a reduction of equity by reducing the par value only. And I said that's purely cosmetic. and has no economic consequences. Here we are in a different situation, because here we literally delete 1,000 shares. What do you think is the impact on the market value of those shares if you delete 1,000 of those shares? Any idea? What happens to the market value when you reduce the number of shares? Market price will increase, that's correct. Hangwu, well, because you have the same company value. This transaction here, canceling the shares, economically does not modify the company value. Remember, company value, we could say, are the expected cash flows discounted. Well, this transaction here has no impact on the future cash flows. Therefore, this company does not change the overall value of the company, but the overall value of the company now is allocated on a smaller number of shares. Therefore, the value for each share will be higher. So canceling my treasury shares is a way, could be a way of increasing my share price. Okay. That's it on treasury shares. Any remaining questions? Not for now. Okay. Then let's talk about retained earnings a little bit. Well, in the US, we have such a thing as the retained earnings statement, something that is not mandatory in IFRS. But in IFRS, remember, we have the statement of changes in shareholders' equity. So I will see the same information in the statement of changes in shareholders' equity. But in the US, in addition to the statement of changes in shareholders' equity, companies need to provide and publish a retained earnings statements. So retained earnings at the beginning of the year, any net income increases that, and any dividend paid decreases that. And then we have the retained earnings at the end of the year. Okay, dividends. We have cash dividends, of course. We have dividends in kind. Okay, so that means shareholders do not receive a cash payment, but products, for example, of the company. So it was a funny thing. One day they wrote a guide in Germany, a guide on all existing shares where you get in-kind dividends, because sometimes actually they have a higher value than the cash dividends. So you can imagine if you're a shareholder of LVMH, the luxury company, which produces champagne. Well, it's better to get a bottle of champagne than a dividend of €2. The champagne has a higher value. So there's quite a few companies where get in-kind dividends, which are products. We can also pay dividends in share. So it means shareholders get no cash dividends, but additional shares. And if I get €10 in cash instead, I may get one additional share with the current market value of €10. It's also possible, and in many companies now, at least in the European Union, actually shareholders have a choice between cash dividends and share dividends. Shareholders can decide what they want. And we have liquidating dividends, so that's a little bit different in nature from the three others. We speak of liquidating dividends when actually shareholders get higher dividends than the profits for which they are responsible. So in other words, we pay out retained earnings of a period before the shareholders came in, those shareholders here. Then we talk about liquidating dividends. And those liquidating dividends are actually like a reimbursement. It's something you pay out more retained earnings than you actually have. that would be liquidating dividends. Okay, let me tell you something about retained earnings and why we are doing this. We discussed this already a little bit in general, but let me show you how this works. Okay, so imagine the company has a profit of 500. Okay. So first alternative and extreme solution, I could say I pay all those profits out as dividends. Okay, why not? Well, if we pay dividends of 500, what does that mean? That means there will be a cash outflow of 500, and the profit that is here accounted for in equity is completely distributed to shareholders. And that means after doing this, well, there is no profit left, which makes sense because everything was distributed to shareholders. So it means paying dividends on the one hand means there is a decrease in cash, and secondly means there is no impact on equity in the end. The profit increased equity, but if I pay the same amount as dividends, well, that means equity will decrease again. Total change is 0, and I find myself with exactly the same equity as of the beginning of the year. Okay, first possibility. Second possibility, I have a profit of 500, but I decide in the second scenario, I decide of not paying any dividends. Okay, so here we are maybe in a situation of dividend payments. Okay, in the next part, we are in a situation where I don't pay any dividends. That means, well, my cash situation does not change at all. Okay, and the profit here is not distributed to shareholders, therefore the profit remains in equity. Okay, remains in equity. So accounting wise, I could do nothing and just leave the 500 here, but usually what we do is we reclassify the amount. So it means I take the 500 now out of equity, out of profit, out of profit, and instead I reclassify them on another line that I call retained earnings. And my retained earnings here obviously would increase by 500. Okay, so retaining profits, what are the impacts? Well, first of all, on cash, retaining profits avoid a cash outflow for dividends. Therefore, the remaining cash position obviously is higher. If I assume in the beginning I have a cash position of whatever, 680, well, if I pay 500 of dividends, my remaining cash is only 180. But if I pay no dividends, my remaining cash is still 680. So dividend decision, therefore, is based also on cash consideration. Should I give the cash to the shareholders or should I keep the cash in the company? So that's the cash impact. And what's the equity impact? Well, the profit that I made of 500 increased shareholders' equity. And now I decide, or the shareholders decide more precisely, to not give any dividends to the shareholders. And that means the 500 remain in equity. So in the end, my equity position has increased by 500. And that is what I said before. That is the organic growth of equity. Because every year what we do is we do have a profit, and then we decide to retain part of the profit and to pay partially the profit in form of dividends. And that means in real life, it's not black or white. The solution is in between. Some profits are paid out as dividends. some profits are retained in the company. Okay, I said also that retaining profits is a simplified version or a solution instead of asking the shareholders to buy new shares. Okay, it's economically the same. That means I could pay dividends, the 500, but then I would ask the shareholders to buy new shares. That means to reinvest this money into the company. Well, if they do this, I would have a cash inflow of 500, and my share capital would increase by 500. And the share premium, etc., doesn't matter here. Okay, well, that means paying dividends and then doing a share increase means my cash position in this case in total would change for 0. And my total equity, of course, would increase by 500 because I asked the shareholders to inject new money. So therefore, instead of paying dividends and then issuing new shares with all the cost and work that this implies, I do the shortcut and I simply retain part of those profits. That means I do not pay out and get back the money. I'm simply not paying anything, so I have the same impact. And I reclassify the profit in retained earnings and therefore also have the same impact. That means an increase of equity of 500. That means the shareholders make the decision to retain part of the profits or not. And this decision actually is a decision to reinvest in the company. So retaining profits is a reinvestment decision in the company. And that means shareholders will agree to retain profits, partially usually, only when they think, well, the company has a future. And therefore we want to reinvest in the company. Okay, that's it on retained earnings. So retained earnings have a cash advantage because you avoid a cash outflow, and have an equity advantage because it makes your equity grow every year a little bit, and maybe this growth is in line with the overall growth of the company. Okay, questions on that, please? No questions? Everything okay? Okay. Then we skip to the next point, which talks about hedge accounting. So, what is hedging? Does anyone know? What is hedging? No idea? Okay. Yes, protect your position through investment. All right. Indeed, hedging is a risk management tool, and we use hedging usually to mitigate risk, to reduce risk, or even to, get immune against the risk. And we can hedge about a multitude of risk. Obviously, all financial risk, so exchange rates, market prices, commodity prices, interest rates, and all that. But also against some operating risk, such as climate risk, for example. If you're in agricultural activity and it rains too much, or it's too hot, or it's not hot enough, etc., etc., and therefore your harvest is bad compared to what you expect, Well, there are hedging possibilities to hedge the risk of losing money because the meteorological conditions are not perfect for you. No? So hedging is an activity where you mitigate your risk. And usually what we do is we have an underlying situation, position. I bought a bond, I issued a debt, something like this, that generates the risk. And then I will put something, Tong, that you called an investment. I will put something against this investment. And the two positions, the underlying position generating the risk and the hedging position mitigating the risk, the two combined lead to a no risk or limited risk situation independently of how the market situation changes. So exchange rates increase, decrease, and so on, doesn't matter. Okay, there are different approaches to hedging. Global position, macro hedging, for example. Well, in a macro hedge, what I can do is, if I look at my balance sheet, so imagine you have a currency risk related to the US dollar. So macro hedge would mean I set up my balance sheet with all my dollar positions. That means I have dollar assets, and maybe we have 100 of dollar assets, for example. And I have also dollar liabilities because I do a lot of things in dollar, generating liabilities. But I have more dollar assets and than liabilities. So here we have a gap of 20 that you can see. Assets are higher than liabilities by 20. Well, a macro hedge means I would do one hedge, one single hedge, and hedge 20. And with this single hedge, actually, obviously that's simplified, with this single hedge, I would hedge my whole dollar balance sheet. Okay, so my dollar risk basically would be gone. That is a macro hedge. So hedging a global position. I could do the same thing with interest rates. So I have assets with variable interest rates. I have liabilities with variable interest rates. I look at the gap between the two sides, and then I do one hedge for the whole variable interest situation. Okay. Secondly, we can do a portfolio hedge. Okay, well, portfolio hedge means I have my dollar positions, but I cut them in different portfolios. So maybe I have operating activities in dollar, assets, liabilities. Maybe I have financial activities, assets and liabilities in dollar. So I would create an operating portfolio and a financial portfolio, for example. And then I would do one hedge for each portfolio. Okay, so if I have two portfolios, I would do two hedges for each portfolio. And obviously the hedge would be a little bit different because the gap is not the same in terms of direction, in terms of amount, and whatever the situation is in the two portfolios, I could adjust. And number three, we have the possibility to do a micro hedge. That means individual positions. So I have $50 asset positions and $30 liability positions. So 80 positions in total. I would do 80 hedges for 80 positions. So each individual transaction would be hedged in this situation. So micro hedging, as you can see, is very work intensive because I need 80 hedges. Okay. But on the other hand, each hedge is very much tailor-made for the individual situation of the position. Macro hedging is much less work intensive because there's only one hedge instead of 80. But obviously it's also less precise because in my dollar balance sheet, well, the timing of the dollar assets and liabilities is maybe not the same, for example. So the hedge that I'm doing will probably not be able to cover 100% of the risk, and there will be a part of the risk that remains open. Okay, so there's three forms: macro, portfolio, micro hedge, three forms of hedges. However, we cannot necessarily apply on all of these hedge accounting, because hedging is an economic economic decision and transaction, and you can do whatever you want. Hedge accounting, on the other hand, is a special accounting treatment that is reserved for exceptional situations, and therefore the accounting standards define in which situation I may be allowed to use hedge accounting. Okay, and what is allowed? Well, in IFRS 9, I can do micro hedging and I can hedge groups of items, which is something close to a portfolio hedge. So roughly, we can say that IFRS 9 allows a micro hedge and portfolio hedge, but no macro hedge. And before that, it was even worse, because the accounting standard before that allowed only micro hedges. So there's two questions. One of all, why is accounting limited to micro hedge? And the second is, what if a company actually uses a macro hedge? What is the accounting consequence? So first question, why in IFRS they apparently push you to do micro hedging? Well, because hedge accounting is an exceptional treatment, and the accounting regulator wants to make sure that you apply this exceptional treatment on very specific situations, meaning individual positions. If they allowed, hypothetically, to do this for macro hedge, that means there's a lot of many things included, and maybe, well, if you include everything, it cannot be exceptional, in a sense. That's the idea. So therefore limited mostly to micro hedges. Okay. Second question, what happens if a company does a macro hedge? I mean, it's not illegal to do it. You can do it. And it works. I mean, even effectively, you may mitigate your risk. Well, if you do macro hedge, you can do the macro hedge. That's possible, but you cannot apply hedge accounting on this situation. Which means, remember, in a hedge, you have the underlying position who generates the risk. You have a second position who offsets the risk. Well, if you do that on a macro basis, but you cannot apply hedge accounting, that means you have to account for those two items separately, as if there is no hedge. Well, because accounting-wise, there is not. Okay. So sometimes that creates situations where accounting-wise, since you cannot apply hedge accounting, you show a risk, which means a profit or a loss, that economically does not exist because you do macro hedging. This is unsatisfactory. That's why companies are pushing that the regulator also allows macro hedging as hedge accounting. But it's a difficult question, and it's not yet over. So the hedge accounting rules, even of IFRS 9, which is a rather new standard, the hedge accounting rules of IFRS 9 are still under negotiations. Okay. And therefore the situation, well, I show you the situation as it is today, but it may change in the future. Okay. So if you want to do hedge accounting, you must fulfill the conditions of hedge accounting. A perfect hedge is not required for hedge accounting. What is a perfect hedge? So remember, you have the underlying position. That's the position that generates your risk. And you have the hedging position. That's the position that is supposed to mitigate the risk. Well, a perfect hedge means that if I lose 25 with my underlying position, so the risk actually became real, my hedging position, I will make a gain of 25. So in a perfect hedge, the gain and the loss of the two positions, they equal up and the total impact is 0. That's a perfect hedge. And vice versa, if my underlying position increases in value, the hedging position will decrease in value. If the total impact of both is 0, we talk about the perfect hedge. However, perfect hedges are, first of all, not required for hedge accounting. So it's not mandatory to have a perfect hedge. And secondly, in real life, well, they rarely happen. They rarely happen. Well, they can happen, of course, but it's most companies work with a non-perfect hedge. Why not? Well, sometimes it's simply not possible to do a perfect hedge. Or sometimes companies voluntarily don't want to hedge their position 100%. So, for example, for foreign currency risk, many companies do not hedge 100% of their currency risk. They hedge only a smaller portion, which means for the unhedged part, there is still a risk. But, the job of a company is not to avoid all risk, because if you want to avoid all risk, you should stop operating the company. That's zero risk. The job of the company is to engage in risk, but in a way that does not endanger the survival, that makes profit in the long run, etc. So therefore, sometimes by foreign currency positions, companies do not hedge 100% of their position. They leave the risk open. If it works good, I make an extra profit. Okay, if it doesn't work out, I make a loss, but the loss is small and does not endanger the overall situation of the company. I said also perfect hedges sometimes simply are not feasible. In particular, not when I work with hedging positions or hedging instruments that are listed on the market. So mostly as hedging positions, we will use derivative financial instruments. So if I use derivatives that are listed on the market, it will be almost impossible to get a perfect hedge. Why? Well, because the derivatives on the market that I can buy and sell are standardized in terms of amount, standardized in terms of dates of execution. So that means if I have a foreign currency asset of 83,500 that is due on March 25, probably I will not be able to perfectly hedge this, because on the market I can only buy hedges for units of 10,000, which means here for my 83,000 asset, I can either hedge 80,000 or I can hedge 90,000, either one, but not 83,000. And when the execution date of those derivatives on the market are standardized and I don't know, are maybe always the 1st and the 15th of the month. So that means my underlying position is due on March 25. So that means as an execution date for the derivative, I can either choose March 15 or April 1st, but not precisely the date. And that means because of these date inconsistencies, obviously there is a residual risk. Okay. So perfect hedges are not so frequent in real life, and they are not mandatory to apply hedge accounting. Therefore, we are okay. Okay, so here are some explanations and the conditions that we need to fulfill to apply hedge accounting. Okay, so hedge accounting, what does it mean? As I said before, I have the underlying position and the hedging position. In regular accounting, I account for each item individually. Okay, hedge accounting means I account for them, for those two positions, as if they were one. Okay, so I put them together for accounting purposes. That is something that we usually do not do, which in general, outside of hedge accounting, is even prohibited. Okay. We have in accounting the basic principle of individual measurement, which means that all assets, all liabilities, all revenues, all expenses have to be measured individually. I'm not allowed to regroup them. I need to present everything separately, and I need to measure everything separately. So it means here hedge accounting in that sense is an exception because it allows me to combine two items and measure them together. But for this, we have the restrictions. For example, well, one restriction I mentioned already here in terms of micro hedges and group of items only. So type of hedge is limited. What I can use as a hedging instrument is also limited because actually only derivatives apply or qualify as hedging instrument except for the foreign exchange risk. Here I can also use financial non-derivatives. That means, as I said before, the Bella balance sheet in dollar, my dollar assets can be covered with dollar liabilities. That's possible without derivatives because here we have a foreign exchange risk that is possible. The hedged item, so the underlying position whose risk I may want to hedge, well, here there are very little restrictions, almost none. Obviously, I can hedge existing assets. I can hedge existing liabilities. Makes sense. I can also hedge a net investment in a foreign operation. What does that mean? Well, mainly here we talk about investments of the parent company in a subsidiary abroad. That means in foreign currency. And net investments is the net amount of all financial links between the parent and the subsidiary. So obviously the parent company has an investment in the subsidiary, okay, but maybe there are also loans between the parent and the subsidiary. So the parent company made a loan to the subsidiary or vice versa. The subsidiary made a loan to the parent company. Well, the investment plus the loan position, all this together is the net investment in a foreign operation, and this net amount can be hedged against the foreign exchange risk. Now, all this assets, liabilities, net investments are items that are on the balance sheet, but I can even hedge items that are not or not yet on the balance sheet. For example, firm commitments. Okay, so I ordered a new machine. The machine will be delivered in 6 months. And therefore, in 6 months, I need to pay $1 million because the supplier of my machine is in the US or not, but he wants a payment in dollars. That's a firm commitment because it's a fixed order. It will be delivered. I will have to pay. Well, I can hedge this firm commitment against the foreign exchange risk, for example, because I'm afraid that when I pay $1 million in 6 months, the dollar is much more expensive than it is today. Okay. And as of today, well, the ordering of the machine obviously is not in my balance sheet. I don't see that in my balance sheet, but it generates a risk, and therefore I can hedge it. So here we have a firm commitment. It's even allowed to go one step further. I can also hedge future probable transactions. So there's no commitment, but it's very likely that I will do those transactions. So for example, as an airline, I know I need to buy fuel all the time, and therefore I have a risk on rising fuel prices, so commodity price risk, but also maybe on the dollar exchange rate because fuel, I need to pay it in dollar. And I know that every month I need to buy fuel. I did not yet commit to this. I did not order the fuel, etc. There's no engagement, but obviously it's clear when I want to operate my aircraft, I need fuel. Therefore, I am obliged to pay and to buy fuel in the future. So I can do a forecast. I can do a hedge on those forecasted transactions, and I can hedge my future fuel purchases. You know, many airlines actually hedge those future fuel purchases over the next 24 months, usually with different degrees. That means the fuel now that I buy in February, the price will be hedged to 90%, whereas the fuel that I will buy in January of 24, this fuel will only be hedged to, let's say, 5%. And the closer the month gets that we are talking about, the higher will be the hedge ratio. And then in December of 2023, well, the fuel purchases of January 2024 will be hedged to 90%. Because all purchases 1 month before, I want a hedge ratio of 90%, for example. Okay, so you see there's a high flexibility in terms of hedged items. There's also a high flexibility in terms of strategy of hedging. So for example, I have a position. I am not obliged to hedge the full amount of the position. I can only hedge 50% of the position or 20%. That's possible. I have, for example, imagine I bought a bond as a financial asset. I purchased a bond of an American company. That means now there is a multitude of risk. There's a risk of default, so credit risk. There is an interest rate risk because maybe the bond is in, well, anyway, there's an interest rate risk and therefore a price risk on the bond, and there may be a currency risk because everything about the bond is in dollar, but my currency is the Vietnam dong. So I have also currency risk here. Well, it's my choice to decide which risk I want to hedge. I'm not obliged to hedge the bond against all risk. So I can hedge it to 100% for the currency risk, for example, but only 50% of the credit risk if I want. So any choice of the risk is free, any percentage here is free. And for example, what is also free is like a rolling hedging strategy, a rollover hedge, which means, okay, I have a risk that runs over 5 years. I'm not obliged in the very beginning to do a hedge over 5 years. I can very well apply a strategy where I do a 1-year hedge and I repeat this 1-year hedge 5 times. So I have a rollover hedging strategy that is also allowed if I say so from the very beginning. So I say so that this is my intention to do 5 hedges of 1 year instead of 1 hedge of 5 years. Okay. All this is possible and needs to be documented. So I have to say so. When I start my hedging in my hedge accounting, I have to write down the hedging strategy. I have to write down which risk I want to hedge. And obviously, I need to designate the hedging instrument and the hedged item, the underlying position. Both needs to be documented. So we need something written saying that who is doing what. Another condition is I need to prove ex ante the economic relationship between the hedged item and the hedging instrument. Well, here we're talking about the hedge effectiveness. How effective is my hedge? That means here we are talking about this part. So if I have a perfect hedge, the hedge effectiveness is 100%. Okay, because gains and losses of both items perfectly compensate. That would be 100% hedge effectiveness. But maybe my underlying position decreases by 100, and my hedging position, my derivative mostly, increases only by 95. So here would say the hedge effectiveness is only 95%. If you take 95 over 100 or 100 over 95, the hedge effectiveness is whatever, 105%, something like this. Well, this is still effective enough. Okay, so as I said, in IFRS, we don't need the perfect hedging relationship, something where the items are related and the closer the better is enough. Okay, so here a hedging relationship of 95% or 105% would still qualify for hedge accounting. As soon as I do not fulfill any of those requirements anymore, okay, so no more economic relationship. By the way, I forgot to say this, the hedge effectiveness, the economic relationship, I need to do this at the beginning of the hedge. So ex ante, I need to prove that based on historical evidence, well, yes, in the future, those two items will be effective. That's ex ante, but I also need to prove this ex post. And that means at every balance sheet date, so every quarter or at the end of the year, I need to prove that, yes, indeed, over the last year, my situation, my hedge position was effective. Okay, so it's ex ante, forward looking, but also at the end of every year, I have to check if in the past that was true. If my economic effectiveness, the hedge effectiveness, is not given anymore, I need to stop hedge accounting. If one of the instruments arrives at maturity or I sell it, well, hedge accounting stops because no more underlying position because I sold it, or maybe no more hedging derivative because I sold it. I stopped my hedging relationship. Then obviously I need to stop hedge accounting. Okay. These are specific criteria for hedge accounting. Any questions so far, please? Okay. Doesn't seem to be the case so far. In hedge accounting basically means, as I said before, the hedging position and the underlying position, I account for them together. Okay, contrary to individual accounting, where I would account for each one individually. So that means the hedged item and the hedging item are accounted for together, and they are accounted for in a symmetric way. Okay, and I will show you what that means. IFRS allows three types of hedges: a fair value hedge, or a cash flow hedge, or a hedge of a net investment in a foreign operation. Remember, that's the combination of all the financial relationships between the parent company and the subsidiary. This third type of hedge works exactly the same as a cash flow hedge. So therefore, I will not present this. And we have two basic forms, which is fair value hedge and cash flow hedge. Okay, what do I do in a fair value hedge? In a fair value hedge, the purpose is to protect my income statement. Okay, that's important. Purpose is protect my income statement. So the risk here is that I will have a loss in my income statement because of the underlying position. In order to avoid this loss in my income statement, I engage in a hedging instrument, which is offsetting. So therefore, that in the end, my final impact on the income statement is zero in case of a perfect hedge. So that's what we would have here, or at least limited in case we have an imperfect hedge. So here, without hedging, there would be a loss of 100, but because of the hedging, the final loss is only -5. So the hedging led to reduction of my risk. Okay, so fair value hedge, I want to protect my income statement. That's the whole purpose. For example, hedge an investment in an equity instrument against falling prices by buying a put option. So can someone tell me what the put option is? What is a put option? Anyone? It's a right to sell, indeed. Okay, so that makes sense. If I'm holding a share in another company, so an investment in equity instrument, I'm holding the share, and now I'm afraid that the share price will drop, and I want to protect myself against this drop. Well, I will buy a put option, because when the share price now falls, actually in the put option, I can sell my shares at a fixed price. When the market value of the shares drops, well, I can sell in the option, or by exercising the option, I can sell the shares at the higher price than the market value. Therefore, the option will have a positive value evolution. That means now, when the share price, the market price of my equity instrument drops, I have a loss on the investment, but I will have a gain on the option. If the hedge, when the hedge is perfect, the gain and the loss set off, and my income statement is not impacted. Or I can hedge an investment in a bond against rising interest rate by selling an interest rate future. Okay, so what is an interest rate future? How can we explain that? Interest rate future is like buying or selling a bond at a fixed price, basically. So what happens here? Well, I'm holding a bond. Well, when market interest rates increase, the market value of the bond decreases. That means there would be a loss on my bond. But I can compensate this loss by selling an interest rate future. It's like selling a bond at a fixed price. Okay, so that means I can sell my bond for whatever, 100. If the market interest rates really increase, well, I can still sell my hypothetical bond for 100, even though the market value is only whatever, 95. So same thing, I make a loss on my original bond when the interest rates go up, but I make a profit on my interest rate future. And if it's a perfect hedge, the gain and the loss, they compensate. Difference between option and future. Do you know that? Because in a put option, I sell whatever I have. In an interest rate future, I sell a bond. So what's the difference between the option and the future? And then we're done for today. Anyone? Song, you are our specialist for derivatives. No, not necessarily the settlement. Settlement depends. Well, obviously, in the put option on shares, we could do a physical settlement because I can deliver you shares. Whereas in the interest rate future, there is no bond to be delivered. It's hypothetical, but mostly we have a cash settlement anyway, so doesn't really matter. Note the option is optional. As you said before, the option gives you a right to sell, no obligation. Interest rate future, it is an unconditional derivative. Okay, so the future will be exercised, and I must sell my bond in the future. It's not optional. So an option is conditional because the buyer of the option can exercise or not the option. A future is unconditional. That means the future must be exercised. And no party here has a choice. It will be exercised in the future, well, unless there's default. But other than that, it will be exercised. Okay, then I propose that we stop here and look at the accounting of fair value hedges tomorrow when we have our last class. Any questions on that before I leave you for the day? Anyone? Well, I guess it's okay. Then thank you very much for the day, and I meet you again